A lot of people get rich in markets by being right. A few get rich by being early. But most people who build serious wealth do it in a much less glamorous way. They stay rational while other people become theatrical. That is the entire game in moments like this. Right now, with war in Iran, with headlines screaming every hour, with politicians contradicting themselves before lunch and again before dinner, with oil flashing on every financial screen, with social media experts lining up to tell you this time is different. The market has become one giant emotional test, and emotional tests are where disciplined investors usually separate themselves from nervous spectators. I want to be very clear with you from the beginning. I am not interested in gut feelings here. I am not interested in chest thumping forecasts. I am not interested in pretending I have a crystal ball when I do not. When the world turns noisy, I go back to the thing that has saved me more than once: history. History is not perfect. It does not repeat in exact detail, but it rhymes often enough to keep an investor from doing something stupid at the worst possible moment. That is where I would start with this whole situation. We are now a few weeks into a war that has created exactly the sort of confusion markets hate. The United States is involved, Iran is involved, oil is involved, the president says one thing in the morning, something else by night. And the public is left trying to decode policy from chaos. In that kind of atmosphere, fear spreads faster than analysis. And when fear spreads faster than analysis, prices move in ugly theatrical ways. That does not automatically make the moment bad for investors. Very often it makes the moment valuable because the stock market does not hand out outsized returns only when the skies are clear. It often hands them out when uncertainty is so high that ordinary people would rather hide than think. That is the first rule. When everyone is certain, prices are usually too efficient. When everyone is frightened, prices are often too emotional. Now let me explain why I would not approach this war with panic. When this conflict began, the broad pattern that mattered to me was not the daily commentary. It was the historical setup around war. If you go back and look at how markets behave when a new war begins, especially when the market entered the war near elevated levels, you usually see a familiar sequence. First comes uncertainty, then comes selling. Then, roughly a month in, you often find a bottom. And after that, the market can spend a long period behaving in a very volatile but very profitable way. For people who understand the difference between price movement and permanent damage, that pattern matters. On the 28th of February, when this war started, the S&P 500 was around 6,900. Roughly a month later, by late March, the market had fallen to around 6,300. Then by mid-April, it had climbed back to the old highs, around 6,970. That is not some small wiggle. That is a full emotional round trip in a very short period of time. Think about what that tells you. It tells you the market was never really pricing a straight line. It was pricing fear, then relief, then doubt again. That is exactly the environment where good long-term investors can do very well, provided they do not behave like frightened tourists. And this is the crucial point. The money-making opportunity in an environment like this does not end just because the first 30 days have passed. In some ways, it is only beginning, because the next 12 months are usually where the real work gets done, not in a straight line, not by calmly floating to the moon while everyone smiles, but through repeated dislocations, repeated drops, repeated recoveries, repeated overreactions, and repeated chances for patient capital to buy what emotional capital is throwing away. That is the second rule. Volatility is not the enemy of the prepared investor. It is the raw material. Now, I want to be honest about the fear driving all of this, because if you do not understand the fear clearly, you cannot understand why the market is behaving the way it is. The market is afraid of oil. More specifically, it is afraid of what higher oil prices might do to inflation, growth, and confidence. The logic runs like this. If oil spikes, energy gets more expensive. If energy gets more expensive, transportation and production get more expensive. If those costs spread through the economy, inflation rises. If inflation rises while growth weakens and unemployment begins to rise, you can get the ugly word everybody loves to revive from the 1970s, stagflation. That is the ghost haunting every conversation right now. And because the 1970s produced a genuinely ugly period, people grab the old analogy and start acting as though the old movie has already begun. But investors have to be more disciplined than that, because a historical analogy is not an automatic outcome. A scenario is not a certainty. The market is pricing a fear. That does not mean the fear will become the full reality people are already imagining. And even more importantly, you have to separate what creates temporary price spikes from what creates enduring inflation. This is one of the places where people become very sloppy. Oil can spike, oil can absolutely create temporary cost pressure. But oil does not, by itself, create persistent monetary inflation in the way people casually talk about it. Milton Friedman said it bluntly decades ago. Inflation is always and everywhere a monetary phenomenon. In plain English, that means the enduring inflation problem comes from money creation outpacing real output. Oil can shock prices for a period. Supply chains can distort prices for a period. Wars can certainly scare prices for a period. But the engine behind ongoing inflation is the money printer, not the geopolitical headline. That distinction matters enormously because it changes how you think about fear. If you think every oil spike is the beginning of a permanent inflationary regime, then you will panic every time the Middle East lights up. If you understand that commodity spikes are cyclical, often self-correcting and constrained by demand destruction, then you stop treating every energy move like the end of rational investing. At $100 oil, people complain. At $120 oil, behavior changes. At $140 oil, demand starts breaking. Businesses cannot pass everything through. Consumers cut elsewhere. The system pushes back. That does not mean prices cannot spike. They can. But it does mean that extreme prices tend to contain the seeds of their own reversal. That is the third rule. Temporary price pain is not the same thing as permanent inflation. And if you confuse the two, you will sell good assets at exactly the wrong time. Now step back from the war and look at the long picture, because that is where I think investors can reclaim their sanity. Suppose you know nothing about the next month. Suppose you cannot predict the next headline. Suppose you cannot forecast the next move in oil or the next Trump comment or the next diplomatic twist. What do you actually know? You know that over long periods of time, the stock market has been one of the best compounding machines ever created. You know that bull markets on average last longer and go further than bear markets. You know that the market has a structural upward bias because it is tethered to earnings, productivity, inflation, innovation, buybacks, capital formation, and the simple fact that good businesses adapt better than frightened humans do. And you know that people who wait endlessly for a better entry usually miss far more upside than they avoid in downside. That is not opinion. That is history from the 1930s onwards. The average bull market has lasted nearly 5 years and generated returns around 180%. The average bear market lasts roughly a year and a half and declines around 35%. We are still only a few years into the current bull run, and even by the source material in front of us, we are nowhere near the sort of mature, fully exhausted profile that would make me assume the whole story is already over. That is not a promise. It is simply context. And context is what keeps you from behaving foolishly when everybody else starts speaking in absolutes. Now, if you think those numbers are too broad, then narrow the sample. Look at the last 20 years. The broad point still holds. Most of those years were bull market years. Only a handful were true bear market years. The good stretches lasted longer and delivered far more than the ugly stretches took away. One stretch delivered something like 400%. Another delivered more than 100%. Yes, there were painful drawdowns in the middle, but the reward side of the equation still dwarfed the punishment side for anyone with patience. That is why I have always found Peter Lynch's old observation so valuable. More money has been lost waiting for corrections than has been lost in the corrections themselves. I believe that not because corrections do not hurt, they do, but because the psychology of waiting is deceptive. People imagine they are being prudent when they wait. Often they are simply being inactive with a nice story attached. Now, let us make this even more blunt. If you try to play the market day by day, the odds are miserable. If you try to swing trade year by year, you are still taking a dangerous game seriously. But if you extend your horizon far enough to a decade, to something like 10 years, the odds historically begin to tilt so heavily in your favor that the game changes entirely. Long holding periods turn the market from an arena of drama into a machine of probability. That is why I think 10 years is such a powerful mental framework. It is long enough that compounding gets a real chance. It is short enough that ordinary people can still emotionally relate to it. And historically, the odds of success over that sort of holding period have been overwhelmingly on the side of the patient owner. That is the fourth rule. You do not need certainty about the next quarter if you have discipline about the next decade. Now, whenever I say things like this, somebody always jumps in with the same line. This time is different. That is the favorite phrase of every frightened generation in 2003. During the Iraq War, people said it. In 2022, during the Ukraine War, people said it. And now, with Iran, people are saying it again. So let us go back to the actual pattern. When Iraq began, the market sold off and then, within roughly a year, completed a round trip back. When Ukraine began, the market fell hard, bottomed, and within about a year completed another major round trip. Every war feels unique while it is happening, because emotion always insists on its own uniqueness. But from the perspective of prices, fear, and long-term recovery, the pattern is much less exotic than the people living through it want to believe. This does not mean wars are good. Do not twist my words. Wars are ugly, costly, and tragic. It means that wars often create emotional dislocation in prices, and emotional dislocation in prices can become buying opportunities for investors who are not trying to make moral commentary through portfolio management. Since 2009, the SP has climbed from under 700 to around 6,900 despite wars, pandemics, banking scares, political chaos, rate shocks, inflation scares, commodity spikes, and all the other episodes that television experts use to declare the end of the system. The system did not end. The chart kept climbing. That does not prove stocks go up every week. It proves that betting against the long-term resilience of productive assets has been a very expensive habit. Now let me come back to valuation, because this is where the current setup becomes interesting in a way most people are missing. From late 2025 to now, the SP itself has not done much in price terms. It is roughly where it was before, but underneath the surface, forward earnings and valuation multiples have adjusted. The forward P/E has come down from richer levels, something like 26, toward 20. That means the market has become materially cheaper without needing a giant headline crash. You are looking at a setup where the same index level can now represent a better long-term forward return profile, because the multiple has compressed. That matters, because investors do not buy index points, they buy future earning streams at a price. And when the price of that stream becomes more reasonable, the odds improve. According to the framework in the source material, a forward P/E of 20 on the SP has historically been associated with something very close to the long-term average annual return. In other words, the market may look scary on television, but for the decade-minded investor, it is actually more attractive than it was a few months ago, without having to advertise that fact through a dramatic collapse. That is exactly the sort of situation the market creates when it wants to confuse people. Prices look recovered, value has quietly improved. Fear is still elevated. That is often a very good combination for disciplined long-term capital. Now, and this is important, none of that means you should blindly buy the dip. I do not believe in blind anything when it comes to money. If you take all your money and throw it in at once just because you are excited by a historical pattern, then you are not investing intelligently. You are gambling that the path will be kind to your timing. The path may not be. The market can absolutely fall lower from here in the short term, a lot lower. That would not shock me in the slightest. And in one sense, it would not even be bad if you are ready. That is the fifth rule. Do not predict the path. Prepare for multiple paths. This is where dollar cost averaging matters so much. If you go all in at one level and the market falls sharply, you are handcuffed. You have no dry powder. You have no ability to lean harder into better prices. All you can do is sit there and pretend that was your plan. But if you are putting money in gradually, steadily, systematically, then a lower market is not a personal insult. It is simply an opportunity to buy more shares at better prices. And if you have maintained enough liquidity to be able to increase those purchases during moments of real fear, then volatility becomes your ally rather than your enemy. Notice what I am saying. Not hide in cash forever. Not buy recklessly all at once. Buy intelligently over time. And reserve the courage and capital to buy harder when other people are emotionally exhausted. That is where a great deal of wealth is built. Not by making one giant heroic bet, by repeatedly showing up with discipline when prices are temporarily irrational. Now, I also want to draw a sharp line between broad market ETFs and individual stocks, because people get themselves into trouble by treating those two things as though they require the same temperament. They do not. If you are buying a broad market ETF like the SP 500, you are buying a self-cleaning machine. The weak names get replaced over time. The index sheds losers and absorbs winners. You do not have to identify which specific company will survive a temporary collapse and go on to dominate the next decade. The index does that for you. That is a wonderful structure for most people. But if you decide to buy individual names, then you are taking on a much harder job. Now you have to identify great businesses, not good stories, not fashionable tickers, great businesses. And once you identify them, you need something even rarer than the stock idea itself. Discipline and conviction, because a great business bought at the wrong time can still punish you brutally before it rewards you. If you bought Palantir in 2022 and then watched it get smashed lower, the business may have still been fine, but your temperament had to be finer. If you did not have the conviction to hold or add, then your stock picking skill alone would not save you. That is why I think most people are better served by broad ETFs for the core of their wealth building plan. Let the index do the maintenance. Let the compounding work. Keep your ego out of it. If you want to own individual stocks, fine, but then you must accept that this is not just about identifying winners. It is about surviving the emotional violence that comes with owning them. When the market temporarily hates them, the sixth rule is simple. ETF investing asks for patience. Individual stock investing asks for patience and courage. Do not confuse the two. Now, if I had to summarize what I think a smart investor should do right now in one sentence, it would be this. Do not sell everything trying to guess the bottom. Trim intelligently where gains are absurd if that is sensible risk management for your life, but do not use warfare as an excuse to abandon a long-term process that has worked across every prior crisis. If you own positions that are up 100%, 150%, 200%, maybe you trim some. That is not weakness, that is housekeeping, but you do not liquidate productive assets. Because a war made television louder, that is not investing, that is surrender. And the final point I want you to hold on to is about the role of the United States in all of this. In times of uncertainty, global capital does not usually run away from the dollar and U.S. markets first. It tends to run toward them. Not because America is perfect, not because our politics are elegant, but because the U.S. still sits at the center of the deepest and most liquid capital markets in the world. And in a world full of ugliness, money often chooses the least ugly sanctuary available that matters. Because while people are busy telling you the world is ending, the structure underneath global capital is still doing what it has often done in crises. It moves toward perceived safety, toward liquidity, toward depth, toward the reserve currency, toward the market big enough to absorb it. Which means that periods of geopolitical chaos often wind up strengthening the very place nervous money was told to fear. That does not mean you should be blind. It means you should be observant. So here is where I land. This war has created fear. Fear has created volatility. Volatility has created opportunity. Oil can create short-term stress, but it does not automatically rewrite the entire inflation regime by itself. The long-term record still favors patient ownership of productive assets. The current valuation setup is better than the emotional tone suggests. And the way to exploit this is not through dramatic predictions. It is through process. Own good assets, buy over time. Keep enough liquidity to become more aggressive on real fear. Use broad ETFs for the core unless you truly know what you are doing with individual names. And above all, stop letting every crisis convince you that the basic math of ownership and patience has somehow been suspended. It almost never has. And every time people forget that, the market winds up transferring money from the dramatic to the disciplined. I know which side of that transfer I prefer to be on.